We're going to pick up here with learning objective number 3 for chapter 25, and we will describe and compute our departmental operating income. So our departmental income is the difference between the gross profits and the operating expenses, as we talked about in the last video. And your book talks about the more common approach being the single ledger account being maintained for each item and then splitting them off at the end of the period, again for a variety of reasons. I don't like doing that. I think it takes an extra step at the end, and if you're going to split it off anyway, you might as well just enter it the way it's going to be reflected in the end anyway. We're going to look at two kinds of expenses. We're going to look at our direct and our indirect expenses. Our direct expenses being things that are immediately traceable to the department, and then the indirect will be things that we can reasonably relate, but basically they could apply across all departments and as opposed to one specific department. So we've got Annie's employees, and they've got 5 store clerks. 2 work in the golf department, 1 in the tennis, and 2 assist customers in both departments. So the golf and the tennis employees are pretty easy to calculate. It's our combined employees that become the issue. So we've got our 2 golf employees that we can allocate very easily to golf, and same with our tennis employee. It's our, again, the ones that cover both that become things, require greater computation. So between those 2 employees that cover both departments, we've got a total of $39,000 in payroll costs that need to be allocated between the golf and the tennis departments. We're going to do this on a basis of total net sales. So we're going to look at what the percentage of golf versus tennis are in terms of net sales. And then we're going to use those percentages to allocate the wages of just the 2 employees that cover both of those departments. And so you can see we've got, so we're going to take the full $39,000 of the 2 salaried mixed department employees and multiply those by each of the percentages, and that will allow us to allocate. This is all an estimation. There is absolutely no way of guaranteeing that the time split of these employees is actually 62.67 versus 37.33. These are merely estimates, and this is one way of making these estimates. We could, as your book talked about, they have to be reasonably related to the department, and this is certainly one way of demonstrating that, but there may be other ways that become clearer about maybe one works Monday, Wednesday, Friday in one department and Tuesday, Thursday the other, and so if something like that were the case, then it would be much easier, or if there were specific shifts assigned to those departments. But in a situation where somebody's floating back and forth all day long between the 2 departments, it becomes more difficult to determine how to make that allocation, so therefore a percentage method like this would certainly be reasonable. And so you'll see here we've got our total clerks expenses. So the $105,250 was all of the expenses, and then we were able to allocate $70,441 and $34,809 to each of the 2 departments. So those are the combination of the our combined employees. So we've got our direct expense employees of $46,000 and $20,250 that are strictly assigned to one department or the other, and then we add to those the allocated percentage of the 2 employees that go back and forth between the 2 departments to get those totals. We've got truck drivers, and we're going to have to make some allocations on our truck drivers' wages also. And for me, fortunately, or unfortunately, it's very difficult the way that my office has been structured traditionally to be able to allocate things as neatly. There was very little direct overhead expense that I could identify in terms of wages and things like that. Office space, I mean, basically all the files occupy all the space, and to try and assign an assistant's salary to on a file-by-file basis would be maddening for the assistant and for me. So the percentage basis is the way that I have gone with that as well. And so we've got, although I will say at one point I did have somebody that was solely dedicated to managing bankruptcy clients. I had a bankruptcy case manager, and so those salaries were directly allocated to the bankruptcy cases. But people who answer my phones, who do the filing, things like that, when I had people in those positions, those would have to be allocated. So we've got our delivery driver and the salary of our one driver who delivers only golf. And then we're going to allocate, and this allocation is based on the dollar amount of equipment that gets delivered. And so this is a 70-30 split. And so our other two employees, the salaries are allocated again by the amount. Now, again, these are just estimates. The dollar amount is an approximation. It may be that somebody spends far more time delivering, I assume, I don't golf, but I think golf equipment is far more expensive than tennis equipment. So you might actually have fewer deliveries involved than you would with tennis. So these, again, are only approximations, and this is one acceptable method of doing it, but there could be different acceptable methods. So we now look at our truck drivers' wages as they are allocated among the two departments. We have advertising through newspaper and radio. And the print ads, they do by the inch of copy space. I'm not sure how scientific that is. And the radio is all considered mixed. So the mixed, they've been allocated, or they will allocate, based on percentage of total net sales of the two departments. And now we're going to split the rent. And this is being done based on square footage of floor space. That's a pretty common method. You'll see a lot of things related to square footage of floor space. We've got our bad debt expense that's written off based on our past experience. Our depreciation expense, we've got our 3 trucks. That's one for golf and the other 2 are mixed. And that's a 70-30 split based on how they deliver equipment. And so we've got our, let's see, we've got our total, we've got our other operating expenses. And so that's basically our catch-all of other items. And those could be allocated using, again, any of the other methods that we've talked about. But that's a pretty big chunk of money to have as just being other. But it's all relative. So a company with substantial, over millions of dollars of gross sales, that's not very much. For my office, that would be a substantial amount of sort of miscellaneous other expenses. So now we're going to look at the our percentage of operating income, and we do this by taking our operating income and dividing that by the net sales for each of the individual departments. And so you can see that the calculations they have here on the bottom of your slide, tennis is 6.8% and golf is 6.8% and tennis is 2.8%. We then look at our operating expense percentages, golf being 42.5% and tennis being 31.5%. And so we're taking the total operating expenses and we're dividing that by our net sales. And so we're going to now describe and compute the departmental direct operating margin, but we're going to do this on the next video. As soon as I find my cursor.